Welcome to another tutorial video. This time around, we're going to be looking at this concept of pro forma earnings versus GAAP or IFRS compliant earnings in merger models. Look at what they mean, what the difference is, and when you should use which of these metrics. The question that we're answering here came in the other day, and it's the following. What is the significance of the pro forma earnings and pro forma EPS and pro forma accretion dilution that you calculate in merger models? What do they mean, and how do bankers use these metrics to advise clients? So as usual, I'm going to give you a short, quick answer and then go into some more detail on it if you have the time to keep watching and look at that detail. If not, you'll get something out of this quick explanation in the beginning. The short answer is that pro forma earnings always make a company's results look better by removing certain expenses. And they let bankers argue in favor of marginal-to-poor deals, in other words, deals that would normally be dilutive or neutral at best, by saying, well, if you add back certain expenses, then the EPS accretion dilution turns accretive, and this deal suddenly looks a whole lot better, and your shareholders may be more willing to approve of it. On a standalone basis, when you're just looking at companies operating by themselves, you will often remove restructuring costs, amortization of intangibles, which come from acquisitions, legal settlement costs, asset impairments, gains and losses, and some companies even remove stock-based compensation. Technology companies in particular like to do that to make their earnings look better than they actually are. In an M&A scenario, you typically add back the new depreciation and amortization on asset write-ups. You write up PP&E and you create new intangibles in most M&A deals, and there is new depreciation and amortization associated with both those, so you will typically add back or remove those expenses. Sometimes you will also remove restructuring and integration costs and deferred revenue write-downs, assuming, of course, that all of these actually appear on the company's income statement and therefore affect their earnings per share. How much of a difference do these changes really make? Here's an example for Merck, which is a company notorious for making these types of adjustments and creating non-GAAP or pro forma metrics. In this case, it's a massive difference. I've pulled up one of the company's earnings reports here, and their non-GAAP or pro forma EPS is over twice as high as their GAAP EPS. And if you look at why that's happening, they're adding back a lot of acquisition and divestiture related costs here. They're also adding back restructuring, even though it's not obvious to us that restructuring is a non-recurring expense. It actually recurs in both these quarters here. And then they have some other legal expenses and gains and losses and other items like that they're adding back. So in this case, it makes a massive difference and it completely changes your impression of the company's earnings per share. Of course, that doesn't tell the whole story. In M&A scenarios, it could go either way in a lot of cases. Here's an example for a hypothetical deal between Starbucks and Krispy Kreme. We looked at a pretend merger or acquisition where Starbucks acquired Krispy Kreme here. Now in this case, the difference between GAAP EPS and pro forma EPS is almost nothing. There's a difference of about 1 cent in some of these years, in year 2 and year 4, but there's hardly any difference because the depreciation and amortization on asset write-ups are minimal in this deal, and there are no other items like restructuring or integration costs or other things like that that actually appear on the income statement. So pro forma or non-GAAP or adjusted or operating earnings in M&A deals tend to make the biggest difference when one or more of the following conditions is true. First off, this metric will make a bigger difference when the deal is borderline accretive dilutive. So if it's 0.2% dilutive right now, then you could easily remove a few of these smaller expenses and flip it into an accretive deal, for example. They will also make a difference when the normal acquisition-related expenses, like amortization of intangibles, are significant portions of pre-tax income. So if amortization of intangibles is just 0.1% of pre-tax income, for example, it's probably not going to make a difference or much of a difference in this calculation. But if it's 5%, it's much higher, and the deal is 1 or 2% dilutive, then removing that amortization could easily flip the deal into being accretive. And then finally, pro forma numbers make a bigger difference when there are other significant expenses like restructuring or integration costs on the income statement, and you're also removing those. Now, this point is a little tricky because oftentimes many of these expenses only show up on the cash flow statement, because they don't affect the company's tax situation at all, so they're not shown on the income statement. So you have to be careful about what appears on what statement when you're doing this analysis. In terms of real life usage, one example of where this might come up is with that Starbucks and Krispy Kreme deal. And let's say that the amortization of intangibles were much bigger. As it stands right now, we assume that 5% of the excess purchase price in this deal was allocated to definite lived intangibles. So about 5% of the 1.1 billion here was created as definite lived intangibles and then was amortized over time in the amount of about $11 million per year, which made almost no difference. As we saw before, GAAP EPS and pro forma EPS under these conditions were about the same. On the other hand, if we change the allocation and we made it, say, 30% instead, so we allocate 30% of this 1.1 billion to these definite lived intangibles instead of 5%, now we get a much bigger difference because the deal is actually dilutive in the first 3 years on a GAAP basis, but on a pro forma basis, it is accretive by a little bit, by close to 1% in each year here. So a banker could present these results to a company or to the management team and say, on a pro forma basis, this deal to acquire Krispy Kreme would be accretive. Therefore, the board of directors and your shareholders would be much more likely to approve of the deal, and you would have an easier time justifying the deal in press releases when you go out to explain it to the press and to investors and to the broader public. Of course, the question is, would anyone actually take this argument seriously? And should you even use pro forma metrics in M&A analysis or any analysis to begin with? There isn't a clear answer one way or the other on these points, but we're going to present the arguments on both sides and then give you our opinions on the issue at the end. The arguments in favor of pro forma metrics are the following. First off, many people argue that pro forma metrics give you a clearer picture of ongoing business performance since they remove many one-time expenses. And if you think about it, a one-time legal settlement paid 2 years ago, sure, maybe it reduced the company's earnings per share and net income in that year, but it's not like it's really a part of a company's recurring business. So it's not proper to be counting those types of expenses and reducing companies' net income and earnings per share as a result. Another argument in favor of pro forma metrics is that they better represent a company's future earnings potential, and that's how investors ultimately evaluate any company. All valuation is based on the discounted cash flow analysis, and in the future, in DCF analyses and in free cash flow projections, you typically assume that these types of non-recurring items are gone or at least do not appear after the first year or two. So if you think about it in terms of future cash flow and a company's valuation, pro forma metrics are much more relevant than the GAAP or IFRS compliant metrics. And then one final argument is that items like amortization of intangibles and M&A deals are not real expenses because they're non-cash and they shouldn't reduce a company's earnings like interest expense does. If a company uses debt to acquire another company, clearly the interest expense they pay on that new debt will reduce their pre-tax income and net income and earnings per share. But something like amortization of intangibles just represents an accounting decision and how much of the excess purchase price gets allocated to certain items. So it's not really fair to put it in the same category as interest expense or foregone interest on cash or the shares issued in the deal, for example. Now, the arguments against pro forma metrics are the following. First off, a lot of companies tend to abuse these metrics and label many items that are actually recurring, like restructuring, non-recurring. The classic example is Alcoa. I've listed here on the right side of the slide their so-called restructuring expenses that they added back. As you can see, they have restructuring expenses in virtually every single quarter in some amount. So in our opinion, it's not really valid to add this back and to remove it and to say that restructuring is non-recurring. Another argument against these metrics is that there's very little consistency in how they're calculated. Companies will remove wildly different items. So you can't even really use these metrics to compare different firms. Some companies might take out restructuring, some companies might take out stock-based compensation, some companies might take out portions of amortization of intangibles or sometimes the entire amount. You have to actually dig through the footnotes and the reconciliation to see what's going on in a lot of cases. And then finally, while some M&A related items like amortization may be non-cash, they still do reflect the cost of doing a deal. And that company that was acquired will become a part of the acquirer's core business in the future. So you can't really look at this and say that it's not a real cost because not only does it reflect an acquisition, which is an actual expense, but it will be a part of the company's core business in the future. And if you don't reflect that cost somewhere, it's as if you're saying that the company gets another company for nothing, and that even if they paid some type of huge premium for this company, it doesn't matter, which is not really correct. So the bottom line is that we are skeptical of these pro forma metrics. It's not wrong to use them, but instead of asking whether or not you should use them or whether you should use pro forma or GAAP metrics, it's better to think about it like this. First off, yes, you can calculate pro forma metrics if you want, but you should always calculate the GAAP or IFRS compliant metrics as well. The second point is that you should never base a deal or investment recommendation entirely on these metrics. You can say, for example, that the deal looks better on a pro forma basis, and you could use that as a selling point, but you shouldn't say, this deal is horrible on a GAAP basis, but it's great on a pro forma basis, therefore you should do the deal. So they can be a supporting point in your arguments, but they shouldn't be your entire argument. And then finally, if you do this, you have to explain or footnote what you're doing so that other people understand which expenses have been removed. Otherwise, your work is going to be very difficult to follow. So that's what we think about pro forma metrics and how they are used in M&A analyses and merger models. You should now have a better understanding of this concept and when they're useful, when they're not so useful, and what you should do if you do decide to use these in your own analyses.